Imagine you have a closet completely stuffed with dirty, broken toys, and you want your parents to think you are the most responsible kid on the block. So you put a fake mustache on your golden retriever, hand him your own piggy bank, and have him buy the trash from you. The room looks perfectly clean, and your parents are thrilled. But the garbage is just sitting in the doghouse, and you used your own money to pay for it. This childish deception is how America's seventh largest company vaporized $63 billion. In the late 1990s, Enron was an average Houston gas pipeline firm. Moving gas through pipes is a reliable, steady business. But founder Ken Lay wanted to transform the company into a Silicon Valley powerhouse. He brought in a consultant named Jeff Skilling as CEO, who instituted a ruthless gladiator culture. Skilling demanded his employees close massive deals constantly under the explicit threat of immediate termination. They launched Enron Online, a digital marketplace that turned energy contracts into high-speed tech commodities. Fortune magazine named them the most innovative company in America for 6 straight years. But physical energy markets cannot scale like software. This disconnect created a vacuum between Enron's actual pipeline revenues and the impossible expectations Wall Street now had for their stock. To fill that vacuum, Enron adopted a theoretical accounting trick called mark-to-market. Let's establish normal accounting with a simple car wash analogy. You charge a neighbor $10, you record that $10 transaction. Factual math. Mark-to-market distorts this. You claim a 10-year verbal contract and immediately demand an allowance based on 5,200 future dollars. Enron applied this to their corporate books. The moment they signed a 10-year energy contract, they recorded the entire decade's worth of projected future profits on their balance sheet on day one. This created a paradox. On paper, Enron looked like an unstoppable cash machine. In reality, many of those deals were absolute disasters, and the company was drowning in toxic, failing assets. Enter Chief Financial Officer Andy Fasto. As the losses piled up, Fasto's role shifted from accounting to financial storytelling. Fasto created dozens of off-balance sheet shell companies, special purpose entities, giving them names like Raptor. The official narrative showed Enron selling its toxic assets to Raptor companies to bring in fresh cash. But Enron was secretly funding both sides, supplying the shell companies with the exact money used to buy their own garbage from behind the scenes. While Fasto and the executives pocketed millions in secret fees, Wall Street analysts provided glowing buy ratings in exchange for lucrative contracts managing Enron's stock offerings. The auditing firm Arthur Andersen was also compromised. They pulled in millions in consulting fees from Enron, essentially acting like a health inspector who helps a restaurant owner grind up rats to sell his sausage. Fasto and the executives built a temporary corporate empire by literally buying their own garbage. By August 2001, the math became impossible to hide. Jeff Skilling abruptly resigned as CEO, claiming he wanted to spend more time with his family. Vice President Sharon Watkins sent a blunt memo to management, warning that the company was about to implode in a wave of accounting scandals. In October 2001, Enron admitted to accounting errors, an announcement that wiped out $586 million in claimed earnings overnight. Panic swept the market. Enron's stock, which had been trading near $90 a share, crashed to under $1 in a matter of months. Auditors at Arthur Andersen spent a frantic lunch break feeding 12 years of fraudulent evidence into industrial shredders. On December 2, 2001, Enron filed for bankruptcy. $63 billion in corporate value vanished. While the executives had already sold their shares, they had actively pushed regular employees to invest their entire 401k retirement plans into the failing company. Workers who had spent decades at the company lost their entire life savings. They were handed cardboard boxes and pink slips, left empty-handed by the leadership they trusted. When a culture demands blind growth and executives turn math into fiction, the smartest guys in the room are usually just finding complex ways to buy their own garbage. Thanks for watching Irony Economics. If you enjoyed this look into the madness of the markets, hit that like button, subscribe, and let me know in the comments which multi-billion-dollar disaster we should decode next.